Started in just a moment, and just wanted to say hello and welcome. Thanks for joining us today. Maria, I see you out there. Thanks for joining. I always think back on decades ago down there in Eugene, doing a 1031 presentation with you in it. A lot of water's gone under that bridge, but hope you're well out there. Morning, everyone. David Moore. It is time to get started. We've got a full hour's worth of information, probably have more than that. I will try to go through it in a timely, with a timely nature in mind. I have a tendency to get going quickly. I guess what I'd like to say is you're probably going to have questions. You may have more questions after this class than you had going into it. And that's just fine. You know where to get the answers. Please don't hesitate to reach out. The only dumb question is one that's not asked. I'm David Moore. I'm with IRA Advantage, and thank you for joining us today. Today's topic, IRA investment options for the future. We are speaking on September 21st, 2022. And a lot of turbulent stuff's going on right now. So typically in a time like we're in, hard assets, tangible assets are where people are headed. Sort of interesting, yesterday I was at my Rotary lunch and sitting there with two financial advisors, and one of them had just gotten out of a class talking about currencies and how, well, which currency is going to be okay. There's a gentleman that actually is speaking to our CCIM chapter next month, if you're interested. Pat Stone from Williston Financial Group, WFG, and he's going to do his economic forecast. He does a great job with that, and he talks about America. And historically, he just said, you know, look, if you want to complain about America, we're still, it's the cleanest dirty shirt. So I still think back to the conversation yesterday at the table with the financial advisors and currencies. You know, if the dollar's a problem, I think we're all in trouble. So anyway, people come to us with their retirement accounts in times like this, wanting to put things into hard assets. What do I mean by that? Tangible assets, gold, silver, real estate. You know, these things are the oldest investments known to mankind, and with a truly self-directed retirement account, you're able to buy all of these things very easily. We're going to talk about how to get that done. We're going to talk about why people are doing these things. We're going to give you a few examples of transactions that we've done through the years. All the examples at the end are actually real transactions that have been done by our staff. There's a glossary at the end too, if you're confused about some of the terms that we're going to use. I'll try to stay away from our industry lingo. Lots of acronyms in today's world, but my background is investment real estate. My brother Tom and I founded Equity Advantage, 1031exchange.com in 1991. And we've done a few 1031 transactions through the years, and we put the IRA side of the business together as a result of our 1031 clients wanting to take their retirement money and go buy things that Wall Street didn't offer, or at least have the ability to go out and diversify outside Wall Street's offerings. And what we found, there was lots of information out there on how to make an investment into a given investment, but really as far as the process to get it done, the steps involved, how to help you get where you want to go. There wasn't a lot of information out there. And so we put that side of the business together in the mid-late 2000s, actually just before that last crash. And we ended up doing a lot of work through that crash on rollover business startups and some bailouts of properties, some other things. But I always like to say the only dumb question is one that's left unasked. And so I've got a buddy, Ed Popkin, in my Rotary Club. He always says, hey, if you don't ask, the answer is always no. So, if you've got questions, we've got a menu on the right side. I don't know if I don't get to those questions. If I don't get to the questions during the course of the next hour, we will address them after the class via email. If you are interested in, if you're a real estate professional in Oregon, this class will give you 1 core credit hour. So if you're interested in that, reach out to C Moore, C-M-O-O-R-E at 1031exchange.com, and she can take care of you. C Moore at 1031exchange.com. This presentation will also be up on YouTube, and we'll be getting out the PowerPoint slides to you after the class has been completed as well. So without further ado, off we go. And we like to say, you've worked hard for your money. We work hard to keep it yours. And this is something that's not new. Okay, self-directed retirement accounts have been possible since the inception of retirement accounts in the mid-70s. All right, nothing's changed. The rules haven't changed. This has always been possible, and it's just a question of who you're working with, whether that plan that you have allows you to make the investment, or the custodian that you currently have allows you to make the investment you want to make. So, a lot of times people say, well, why have a self-directed retirement account? I'd say the real question is, why not? I mean, why would you limit yourself, pigeonhole your investment options into just a simple menu versus something that would literally allow you to make any investment the law allows? So I would put it out there, it's like, why wouldn't you want this? Now, if we're talking about IRAs, understand that this is not an all or nothing situation. So you can self-direct any component of your retirement account. If we're talking IRAs, it's not all or nothing. And the reason I bring that up is when we're looking at a truly self-directed account, they're not right for everybody. Okay, you've got to be really diligent and understand the rules, the basics of it. Don't get out over your skis. And really, if you look at Wall Street's investments, you have the ability to make a bad investment, but you really don't have the ability to commit a prohibited transaction. In my world, that prohibited transaction could happen very easily, and you've got to be very, very careful. So these accounts are not for everyone. You've got to be somebody, in general, I would say my clients, come to me. They've had the wherewithal to put a chunk of capital into their retirement. That in and of itself, is something that exhibits somebody with self-control. But with that said, you really need to make sure you're set to go with these things before you go out and find investments. A simple example of a prohibited transaction and an example of what I'm talking about is, we advertise on the radio a lot. We get calls and say, okay, can I do this? Can I do that? And we'll answer those questions. Well, it takes, in today's world with IRAs, people just don't want to work. So the trust companies are having a hard time getting enough staff. Heck, we're having a hard time getting enough staff. But it takes roughly a month to put one of these accounts together. Now, a common problem is that somebody will call up, ask questions, they can or can't do something. We'll say, oh yeah, sure, you could do this or do that. And then we talk about that month in preparation to get it together. And then inevitably, if it's a piece of property, all of a sudden the thing comes on the market and they're ready to make that offer before having the account established. Now, if you're a real estate broker, you got to understand what's involved with doing it. If you're the investor, you've got to be understand what's involved with getting these things taken care of. And that prohibited transaction can happen as easily as you tying up a property personally. Let's say you write a purchase sale agreement between the seller and you personally, and then you want to assign that purchase sale agreement over to your retirement account. You cannot do that. That's a prohibited transaction. So we want to make sure that if you're looking at these things, you get the account set before you go shopping, because inevitably you're going to find something you want. And if it's not structured, it's going to be a situation where it's hard to even write an offer. And if you're a real estate broker, you got to understand, look, if somebody comes to you with a retirement account, you want to know what type of account's involved and you want to, number one, make sure that it's set up. But we'll talk about writing offers in a little while. And it's just, once again, those who fail to plan to fail. So make sure that you ask the questions, make sure you get the accounts established sooner rather than later. And the reason I say with IRAs, it's not an all or nothing situation. I want to see the money that you want to use in the self-directed capacity moved in the self-directed account. Keep your Wall Street money where it is, because by segregating those two accounts, you minimize any risk of a prohibited transaction. We'll talk about that a little bit later. But like I said, when we're talking about a self-directed account, why not have an account that allows you to do what you want to do? If it's an IRA, any restriction in investment today is really going to be based upon the trust company or the custodian and what their menu of investment options are. As far as 401k plans, that a restriction, if there is one, is going to be in the plan document. And it's really been interesting to me through the years to look at these plans and actually review what they do allow or don't allow. And I've had many discussions with trustees and administrators about what their own plan says and what their own plan actually allows somebody to do. So an example of that would be a few years ago, we've got a client, a 1031 client and a retirement client. He's an ex-IRS auditor, CPA, real estate professional, and he had a time-sensitive investment that he had to make. And I said, well, let's look at your current 401k plan and see if it allows the investment you want to make. And after reviewing it, that investment was possible. And I told him, I said, look, go back to your administrator and say, hey, this paragraph, this sentence says you can make this investment. You'd like to make that investment. So he did that, and the administrator said, no, you can't make that investment. I said, well, let me talk to him. So we went through it. I pointed out the paragraph and sentence that's specifically stated he could make the investment that he was interested in making. And I explained to that person, I said, look, it's to your benefit to take care of your client, and it's in his best interest to stay with you. Now, if this doesn't happen, obviously he's going to move the money to me, and I'm going to put this new account together. But in the best interest of time and honestly cost, it was a better situation if he could just keep it where it was. So after reviewing everything, that administrator finally came back to the gentleman and said, well, hey, yes, you're right. Yes, you can make this investment, but it's going to take us 60 days to approve the investment. I said, okay, fine, that's it. Boom, we took the money and moved it into a new 401k plan. So, that's an example of one that didn't work. I've got another example where a pharmacist had a note he wanted to buy. And once again, that discussion about what his current plan allowed him to do, he had been told it didn't allow him to make that investment. We went and reviewed it, took a look at it, turned out that it did allow the investment, and it just required some posting that needed to happen and did happen, and he made the investment using his existing plan in that situation. So we didn't have to make that change for that gentleman. The other one, we had to make the change. So the best thing to do is ask the questions, take a look at what you have, understand what those things say, what investments they allow you to make. And if you have an IRA that doesn't allow you to go do what you want, or a 401k plan that doesn't allow you to go do what you want to do, we're going to look at how we can make that thing happen. So anything's possible, as my wife likes to say. So a self-directed account, self-directed is not a legally defined term. It's just a term that describes an account that allows you to go out and buy what you want to buy. And when we're looking at a IRA, for example, as I stated previously, really we're just going to move money from a trust company that won't allow you to do what you want to one that does. It's a pretty simple process. And as I said, it's not all or nothing. Move what you want to use in this capacity. If we're looking at 401k plans, we're just going to look at the plan, see if the plan allows you to go do what you want to do. If it doesn't, can the plan be amended to allow you to make that investment? If it can't be amended, maybe we have to replace it. So any of those things are possible, and it's just a question of understanding what you have, what's possible with what you have, and if a change is necessary, we will make those changes. But any IRA can become self-directed. When we're looking at 401k plans, it's a little bit more complicated. We'll talk about it a little bit. So, when and how can I create a self-directed IRA? Okay, if we're looking at self-directed IRAs, if the source of funds is an IRA, as I said previously, any IRA can be self-directed. So we don't have to worry about anything with IRAs, whether it's a beneficiary IRA, one that's been inherited, whether it's a Roth, whether it's traditional, whether it's SEP, any of those things we can roll into self-directed retirement accounts. If we're talking about moving money from a 401k plan into a self-directed IRA, for example, then it's a little bit tougher because we have to look at a situation where if you're happily employed and it's a current employer plan and you're under 59 and a half, you're not going to get access to that money. At 59 and a half, you then have access to that money and you can move any portion of it from that plan into a self-directed IRA. Okay, so once again, any IRA can be self-directed. If we're looking at 401k plans, current employer plan, and you're under 59 and a half, we're stuck. If it's a previous employer plan, then we can use those funds. If you hit 59 and a half, then we can use those funds and roll them. So it's just a question of what, how old you are and whether it's a current or previous employer plan, whether we're going to be able to access the 401k funds. But once again, any IRA can be self-directed. And the comment down here, we had COVID, we had a lot of people sort of displaced, a lot of people just decide they weren't going to work, and in that situation, you cease to be employed, you can take that 401k plan, previous employer plan, and roll it into a self-directed IRA. If you're self-employed with no employees, we're probably going to do a solo 401k for you. But a lot of those things happened during that period of time when people were just sort of withdrawing from their employment. And just a word of caution. Years ago, we had a client that left one position, left one company, and engaged us to put a self-directed account together. We were working to get the self-directed account together. He took employment with a new company. He took that job without understanding that the new company had the same parent company as the old company. The new plan was the same basic plan as the old plan. And we had no ability to, he took the job too quick. The money went from, into the new plan, and we could not self-direct at that point. So really understand before you make changes, make sure you're getting where you want to go, and ask the questions. I've had people quit their jobs to get access to money. I had a gentleman in the last crash that basically told me, he said, look, I can't afford to work for another decade to get back to where I am. I want to self-direct. His plan at that point in time didn't allow him to go to cash, and a pretty sharp guy, because he saw that last crash happening and wasn't interested in participating in it. So we rolled his funds out of that. He like I said, resigned. We rolled the funds and created the self-directed account to get him where he wanted to go. And as I said, if you're having a situation where you've lost a job or you want to go out and create a new business and work for it using the retirement account, we can do that using a rollover business startup. I've got an example right at the end. If you've been in my classes before, you've heard me give the example, but it's a great one because the investors, the IRA owners end up with an investment, a job, and a place to live, all with the one transaction, which is just an amazing deal. So never say never. Why a self-directed retirement account? Okay. Number one, I mean, what's happening with the stock market today? Today it's up, yesterday was down. What's happening with the interest rates? What's that going to do to the stock market? And obviously, that stuff's all supposed to be baked into the numbers, but it keeps bouncing around. So people get tired of that roller coaster, so they want to self-direct. Hard assets, for example, real estate's not considered liquid. The downside of it is maybe it's not liquid. The upside of it is it gives stability because of the lack of liquidity. So tired of the stock market's roller coaster. Greater financial control. So if you want to go and do something locally or work with something or just diversify into something that really doesn't fluctuate in value. Maybe you want to go buy a note and just have somebody pay into your retirement account. What's the cost of money today? And I guess that's one of those things. Once again, we're talking about September of 22. And a lot of people are having a lot of heartburn over interest rates today. Well, I've been involved with investment real estate for over 30 years. And if you go back in the 80s, I mean, what was the cost of money then? It's still on sale, I would say. But we've got a lot of people that have never seen interest rates at 5 or 6%. It's really freaking them out. And I would say, well, gee, it probably where it should be. But if you want to you want to buy a note, you can do that. You want to be a lien holder on something. You want to go and put a fund together. All these things are possible. So that financial control, you can do what you want, as you want, when you want, with a truly self-directed account. You don't really have to wait. If it's a checkbook IRA, solo 401k, investments can be made by simply writing a check or wiring funds into something. So it's very immediate, your ability to invest. Invest in what you know. Now, unless you're a politician, you're not legally able to do that, right? I mean, so, and that's sort of tongue in cheek, sorry. But if we look at investing in what you know, insider trading is a big problem. Well, if you're a mortgage broker, for example, you want to self-direct your retirement account and make loans to people, you could do that. If you're a real estate broker, you probably have a level of knowledge beyond the general public on real estate. Why not take advantage of that and reduce risk? I mean, that's what diversification does. Gives you the a more diverse and financial portfolio, and hopefully it's a way to mitigate risk. And so why wouldn't you want to do that? Increased investment flexibility, obviously, anything the law allows. Real investments, not alternative investments. That's something that once again, if you've been to my classes before, that's sort of a irritation to me. Why is real estate considered an alternative investment? Name an older investment than real property. So I would say hard assets are the real investments, and things like synthetic derivatives are the things that we get in trouble with. So community-based investing, you want to make a difference locally, you can do that. You want to go buy a property locally, do it. You want to make loans locally, do it. So that community-based investing is something that's definitely possible. You can make a difference there. My father-in-law was a very charitable guy. He used to ask me how he'd decide what he was going to get involved with. He says, it's easy, go where you can make a difference. Hey, if you can make a difference somebody's life, do it. And as long as they're not a disqualified party, you can make those investments and really make a difference on a local basis. Take advantage of today's opportunities. Once again, investment immediacy. What do you want to buy, and what's it going to take to do that? And what funds do you have access to make those investments? Why not have an account that literally allows you to make any investment the law allows? We talked about tangible asset security. You're putting the money where you want it. Now, you could have your money with some trust company halfway across the country that you've never seen, never met, don't know, or you could have a checkbook IRA with a bank account in the bank that you typically work with, right there in your community. So that security piece is a peace of mind for our clients, because they're literally putting that money where they're comfortable with people they know, and it doesn't have to be halfway across the country with somebody they don't know. Cryptocurrency, well, that's a possibility. Is it a good idea this week? Well, maybe, maybe not, right? I mean, if I look back over the last half dozen years, we've had a series of ads on this topic, and in one year they'll be very well received. The next year it's crickets. Obviously, it's depending on what's going on with that. But if you want to go buy crypto, it's possible with one of our accounts. Businesses, new business. Well, if you're just making an investment, a checkbook IRA or a regular, even a basic self-directed IRA is going to allow you to do those things. Certainly a solo 401k would. Now, if you're going to go and actually create a business that you want to work in, that's going to require what's called a rollover business startup, or a ROBS, and we will be talking a little bit more about that a little later. What are common objections? When I talk to people about this stuff, as I said, we got started in it because people were looking for a solution, looking for a way to do it. The information wasn't out there. And so we put IRA Advantage together to help that. Now, I don't sell investments. Our firm doesn't sell investments. We don't give investment advice. We provide the investment vehicle. So if we're talking about tax money, we've handled tax deferred exchanges, 1031, and that's just conduit out of what you don't want into what you do want. It's our job to take your sale and purchase and turn it into an exchange. if we look at, and I would say that a 1031 is just, in general, let's say real estate's IRA or 401k. Now, on the other hand, if we're talking about IRAs and 401k plans and taking that money and going out and literally being able to invest in anything the law allows, once again, we're not selling you anything other than the investment vehicle that allows you to go do what you want to do. So I've had lots of conversations with lots of people over many, many years. These are examples of people's, sort of objections to the process. So number one, why would you take a retirement account and go out and buy, a piece of property when you lose long-term capital gains tax rates? Well, yes, that's true, but there's no investment you're going to make with a retirement account that's going to give you those things. Now, understand that a traditional retirement account, traditional IRA 401k, it's pre-tax money that's going to grow tax deferred. What do I mean by that? Well, you're going to pay tax on any distribution you take out of that account. All right. So the money that goes in is pre-tax, it grows tax deferred. At some point, you're going to have to take it out. As we get older, I'm probably a lot more concerned with how I'm going to get money out than putting it into that account. But we really look at it and say, okay, nothing you buy with a retirement account is going to give you long-term capital gains tax rates. So to say, well, why would you take that money and go buy real estate with it when you lose that long-term rate? It's really, that statement doesn't mean anything because it's not unique to real estate. Anything in there is going to be taxed. It's just a question of how you're going to get it out with the least tax possible, right? And let me, stress once again, a Roth IRA is just tax money that's going to grow tax-free. Now, that doesn't mean that you're not going to ever have any tax exposure. This next bullet point talking about leverage, a leveraged investment, even with the Roth IRA, is going to have some tax exposure because there's tax on that leverage. Now, that leverage, once again, is something that people say, well, gee, why would you take your retirement account, go buy real estate because you can't get a loan? Well, yes, you can get a loan. It's got to be non-recourse IRA 401k compliant debt. In a nutshell, what that means to you is that the only recourse the lender has in a default is to take that asset. That loan is not going to be attributable to your income, your credit. It's not, they don't have the ability, you cannot be a guarantor personally for an IRA owned asset or 401k owned asset that's got debt on it. All right. So once again, you can leverage investments, got to be non-recourse debt. Easy places to look for that, and we'll talk about it more in a bit, is myiralender.com or iralending.com, for example. What about RMDs? Once again, the comment about real estate not being liquid. So what happens, this is the argument. Gee, we go out and we take the retirement account, we go buy property, now you get to 72 years old. Yes, I said 72, it's no longer 70 and a half, so you're at 72 today. And you've got to take an RMD and you don't have any cash. So what do? Well, you're trapped. You're going to have a penalty, according to a lot of people. Well, that's not true. If you don't take the RMD, you're going to. But the easy thing to do is just to take a piece of that asset out. Or let's say if the asset's owned by a limited liability company, whether it's via a solo 401k or a checkbook IRA, you just do a simple assignment of membership interest of that entity, and that is then your distribution. That could be your RMD, required minimum distribution. So what we're talking about is in-kind distributions versus cash distributions, and we'll talk more about that in a little while. Finally, lose interest deductions, depreciation. Yeah, that's true, because I guess the thing I haven't said yet is that I always describe these retirement accounts. You think it's your money, you think it's you. Don't look at it that way. Think of it as Susie down the street. You wouldn't take her money, you wouldn't sign as guarantor to her loan, you would not take any piece of the proceeds, you wouldn't be buying her insurance or anything else, right? Let Susie's stuff stay Susie's. So when we're looking at anything that your IRA or 401k owns, do not look at it as you. Look at it as somebody else, and that's the best safeguard you've got, because once again, if you go out and buy a piece of property, it's not an additional parcel on your homeowner's policy. It's a different policy for the retirement account that's covering that property. So, any money that's generated from that investment is not yours. It goes back to the retirement account. Any expense that thing is getting saddled with, it's not your expense. And something else I'd like to say, if we've got tax for unrelated business taxable income, that could be triggered by leverage. It could be triggered by conducting business. Those tax obligations, that tax consequence of those actions is not yours. Once again, it's the retirement accounts. So we want to make sure, and this is something I haven't talked about, anytime we're working with any of the stuff, I want you people to have a great team to work with, right? And I think the most important person, I said this yesterday with one of my CPA friends, once again at Rotary lunch, and we were talking about, he's, once again, we're talking mid-September, so he's in the midst of his tax season getting through, and he's pretty tired at this point. But I always joke, I said, look, use your tax people not April 14th, use them throughout the year, and talk to them before you're doing things, because you'll want, especially with the IRS, once again, we're looking at President Biden, just passed, that bill, and he's wanting to hire 87,000 new auditors. Those people are going to be looking for stuff, obviously. So we want to make sure that you've got good tax people, you're using them. If in the tax world, let's say with 1031s, you want to talk to them before you sell something, so you understand what your tax obligation is. In this space, you want to make sure they understand what's going on and they're comfortable with what you're doing, because if you're ever audited, you don't want them to throw their hands up and say, well, I told them not to do that. You want somebody that's going to be there, take a position to take care of you, understands these things, and they're out there. It's something you've got to ask those questions once again, but get a good CPA. I think those people are very, very important in my clients' lives. So once again, finally at the bottom, lose interest deductions, depreciation. You're not going to get that with anything else you buy with a retirement account. So once again, I'd say that statement is really pointless, but it's one that I have discussed many, many times with our IRA 401k clients through the years. So everything you need to know. I like simple. I got a good buddy that used to love the KISS principle. Keep it simple, stupid. So if I'm looking at a 1031, I look at 4 basic things that need to be dealt with. One, it's got to be an exchange. Somebody's selling something, buying something, we turn it into an exchange. What's given, received, or like kind. We need to go across or up in value and equity. And finally, we have to have continuity of vesting. Okay, the biggest headache with any exchange is time. Second biggest is vesting. When I look at retirement account, it's even easier. Okay, so we're looking at 2 issues here. What do you want to invest in? And who are you transacting between or for the benefit of? That's it, all right? What do you want to buy and who are you transacting between or for the benefit of? Those are the 2 questions I need answers to. When you call me asking me questions about whether you can or can't do something, I want to know what kind of account you have. I want to know where it is. I want to know your age, and I want to know what you want to invest in. And then we're going to talk about creating the investment vehicle that's needed for you to get there. The best investment vehicle, not just an investment vehicle. So possible investments. What can an IRA buy? I mean, we would sit here literally all day long if we talked about what an IRA could buy. So we're going to talk about what an IRA can't buy. And it's simply collectibles, life insurance contracts, or stock in a sub-S corporation. That's it, okay? The way the law reads, unless it's specifically prohibited, it is therefore allowed. It's just got to be for investment purposes. So, you name it, your IRA probably can buy it. Okay, 401k plans, it's even more liberal. The only thing you can't buy with a 401k plan is collectibles. So, you want to, once again, buy notes, do that. You want to go buy crypto, you do that. You want to go out and buy gold, silver, palladium, do that. You want to go create a mine. You want to go out and create a business that's mining those elements. You can even do that using a rollover business startup. So rarely is a question of whether we can get it done. It's how are you going to get it done? And with restrictions on investment, solely collectibles, life insurance contracts, or stock in a sub-S corp, odds are you're going to be able to go make those investments. Just question how we're going to get you there. So what are you buying? Who are you transacting between or for the benefit of? So who's a problem for you to transact between or for the benefit of? All right, disqualified parties would include lineal ascendants, descendants, their spouses, or any legal entity, owned in a controlling interest by one of those. So I didn't say anything about siblings, aunts, uncles, cousins. Those people are not disqualified parties. If we're talking about a 1031 and the related party rules with section 1031, siblings would be included in that. But if we're talking about retirement accounts, IRAs, 401k plans, those siblings are fine. Aunts, uncles are fine. Cousins are fine. None of those are disqualified parties. Now, I want to stress, if you look at the bold at the bottom there, you can't transact between or for the benefit of a disqualified party, but you can transact along with a disqualified party. What do I mean by that? If you want to go out and buy something jointly with your retirement account, you can do that. That's not a problem. If we're talking real estate, there's two different ways to do it, depending on what you're doing, what source of funds are. One way might be better than the other. There's no perfect way. But if you want to combine personal money and plan money into a common piece of property, you could do it as common members of a limited liability company, or you could do it as tenancy in common or TIC. All right. And each of those has ups and downs, but either one of those structures is going to allow you to jointly own that property. So once again, buying from, selling to, loaning to, borrowing from, using, all these things are prohibited transactions, when we're looking at these retirement accounts and disqualified parties. But if you want to go out and jointly buy something together, that would be fine as an investment. All right. So pitfalls, traps, as I said, borrowing money from it, selling property to it. That middle bullet, receiving unreasonable compensation for managing. The reason that's in there is people, well, probably a decade ago, I was giving a class at the Washington Association Realtors have what they called EdCon, and I had a broker come up in the middle of that, or after the class was over. So I love my self-directed IRA. And I asked her what she was doing with it. And she was, flipping properties. Number one, that's a business. So you'd probably be subject to unrelated business taxable income. But, that's a question of, getting away from, let's say, dealer status issues. If you're looking and concerned about that in 1031 space for I don't know how many decades we've used the Clarkowski court case. So I use that for 1031 purposes to determine dealer status. I use that same court case if I'm looking at IRAs and 401k plans with respect to anything that could trigger UBIT, unrelated business taxable income. So you're looking at these things, as far as management, the sweat equity is not okay. So you can't, if you're going out and buying a property and you want to go work on that property, you can't work on it. And you say, well, gee, I didn't take any money for it. I'm just out there helping that thing. Once again, sweat equity is not okay. You can do the administrative functions of management, but you can't go out and wield a paintbrush or swing a hammer, that type of stuff. So we say don't get dirty on that thing. And the issue, and you're saying, well, gee, why shouldn't I be able to do that? And I mean, logically speaking, you think, well, hey, if I am putting sweat equity in the property, ultimately my retirement account is going to be worth more. So I'm increasing the value without a corresponding expense. Why should the government have a problem with that? You're going to pay the tax on distribution, right? You're paying more because you didn't have that cost, so you got more in that account. Well, the reason for that is if you're not paying these contractors to do all this work, they're not paying normal income tax, so the government's foregoing all that income today. I mean, at least that's sort of my rationalization of that. It's the only way I can think of it, unless I always joke some senator wanted to do something that's how it applied. So we don't want to see you compensated in any way for managing an asset, but it's in there just to make my lawyers happy, I guess. Okay, so using something is, using your property, something else as security for a loan, that's a prohibited transaction. So we can have a loan on an IRA 401k owned asset, but it's got to be non-recourse debt. So once again, the only recourse the lender has in a default is to take that asset. They can't go after your plan. They can't go after you or any other disqualified party to make themselves whole. Okay, buying property for personal use. Okay, you can't buy something for mom to live in. You can't buy a property at the beach to go use. You can buy a property at the beach that you'll retire into at some point in time, but you cannot use that property, nor could any other disqualified party use that property until it's been taken as a distribution. So once again, we talked about in-kind distributions earlier when we were talking about overcoming objections, right? Now, the other thing we didn't talk about, though, is many of my clients buy things that they ultimately want to own, whether it's an income property or it's that place at the beach they've fallen in love with. Well, they can take that property as a distribution. If you take the property out at one point, one time, you need to have an appraisal done, and all the equity in the property is what's being taken out. So you can be taxed on all the equity in the property at normal income tax rates, as long as you're older than 59.5. If you're under 59.5, you're going to pay that tax plus a 10% penalty. So, another option is take pieces of it out over time, and we'll talk about that a little bit more later. So the issue with a prohibited transaction, all right, we don't want to see you have a prohibited transaction. As I said earlier, Wall Street investments, you can make a poor investment, but it's really impossible for you to commit a prohibited transaction. When we're talking about retirement accounts, it's possible, so we want to make sure that you are very careful. If you have a debit card for your checkbook IRA, you go roll through McDonald's, 10 bucks later, you just blew up your IRA. You don't want to do that. Now, what's interesting is a 401k, the consequence of a prohibited transaction is totally different. So if you're a real estate broker and you're coming to me and you've got traditional IRA money or a previous employer 401k and you're now a real estate broker without employees, I'm going to say, let's use a solo 401k instead of an IRA any day of the week for a variety of reasons. But one of them is that a prohibited transaction with that 401k plan just triggers tax on the money involved with indiscretion. So my McDonald's scenario, maybe you just lost, $4 of the 10 you just spent. Well, you do that same thing with a checkbook IRA. You blew up your entire retirement account, and all funds in the account are treated as distributed as of the first day in the year in which the indiscretion occurred. So if you remember earlier, I talked about IRAs. It's not all or nothing. I would just use the money you want to use in a self-directed capacity, move into the new account, keep your Wall Street investments, that Wall Street money where it is, because by segregating those two accounts, only the money in the self-directed account is encumbered by that prohibited transaction, or the potential for a prohibited transaction, where you're keeping your Wall Street stuff where it is and it's protected. We've had people create separate, disinterested retirement accounts too, and that way you're segregating it in the self-directed world even. So looking at what we're doing, just planning ahead once again. But with 401k plans, you don't have to worry about that. It's just the money involved with the indiscretion. So if we're looking at real estate, and typically people come to me when they want to buy real estate. What kind of real estate qualifies? Rental house, apartment buildings, office building, retail centers, land, any real property to be held for investment of future retirement homes, possible, even oil and gas investments are possible. Real property, oil and gas investments. So we've got some preferred partners in that space that I really enjoy working with. You can't buy a primary residence. You could buy a property that someday is your primary residence, but you just can't use it, nor could any other disqualified party use it until it's been taken fully out of the retirement account, so that we're not committing prohibited transaction there. Second home, same scenario, same problems there. Home for a disqualified party. Once again, you can't buy something for mom. Mom's a disqualified party to your retirement account. The other question that comes up a lot is people would like to take their retirement account, go buy an office building to use in their business, and that would be something that does not qualify. So we have to be careful with what's going on there. So how do we create these things? All right, pretty easy to create. We're talking IRAs. We're just moving the money from a trust company that won't allow you to do what you want to one that does. If we're talking previous or a current employer plan under 59.5, we're really stuck in those things. But it's a simple rollover into that IRA. So any IRA can be self-directed, and the 401k plans where we've got those restrictions. If we're looking at a basic account, if you're looking at something that doesn't, if the investments are not time sensitive and there's nothing unique to them, and they're not management intensive, for example, if you go buy a rental house, you're probably going to want a checkbook IRA or SOLA 401k. If you're going to manage them, it's going to require that. And if, the reason I say that is a basic self-directed IRA, number one, how do you buy the property? Okay, and the reason I say how do you buy the property comes back to my comment with the brokers. So if your account's not set up, then you're probably just going to look at writing the offer between the seller and the taxpayer and then assigning it over because your purchase sale agreement is assignable. That once again constitutes a prohibited transaction. So we need to make sure it's ready. Now, let's say you participate in this webinar and you're saying, okay, well, gee, David said be ready. So you've got a basic self-directed IRA. And if you're a broker, you want to know what kind of account your investors got, right? So your client says, hey, I've got a basic self-directed IRA. What does that mean to you? Or, how does it impact you if you're the investor? How does it impact you if you're the broker? Well, what it means to you is that the trust company ultimately is going to be the legal owner of that property. So if you look at a deed of an IRA-owned asset with a basic account, that deed's going to read, ABC Trust Company, CFBO custodian for benefit of, John Smith, IRA number, whatever it might be, okay? How do you write that purchase sale agreement? Who are you writing the agreement between, the seller and the trust company? Who's got the power of the pen for the trust company? What's going to be involved getting the IRA, that earnest money even? It's a complicated process, where with a checkbook IRA, it's simple because what happens, and we've got a slide coming up talking about checkbook IRA, but really now you're just writing the offer between the seller and a limited liability company, that your client, the taxpayer, is the manager of that LLC, the member is the trust company. So you're just writing an offer between the LLC and the seller. Pretty simple deal. If we're talking 401k plans, it could be either direct plan ownership or it could be the plan via a limited liability company. Once again, either way is going to work, going to be just fine. But when we're looking at a basic account, we want to make sure that if you've got a basic account you're going to buy property with, you want to include a contingency in the purchase sale agreement stating that this offer is subject to the custodian's approval. If there's a loan involved with that thing also, you need to, most state forms include a loan provision in the purchase sale agreement, but they're not going to include a provision that talks specifically about IRA specific non-recourse loan. So we want to make sure we've got an additional contingency in there stating if there's a loan that's required, that's subject to the IRA's ability to get that non-recourse IRA, specific loan. So a few extra things that need to be done, but the bold at the bottom, if we're talking a basic account, everything that happens is subject to the custodian's approval of those things. So it takes time to get things done. So usually somebody might come in and they say, hey, just a basic account's going to be fine. That's all I need. And they sort of dip their toe in the water. And then ultimately they get frustrated because they want to have immediacy of investment. They find those, say, they want to be able to write the purchase sale agreements, and they ultimately end up with a checkbook IRA. So a checkbook IRA simply means that we're creating an IRA specific limited liability company. We're inserting that between the trust company and the ultimate investment. So we're going to take money from your 401k plan or your other IRAs, whatever it might be. We're going to move those funds into a new custodial account. And after we've created that account, or as we're creating that account, we're going to create the IRA specific limited liability company. Ultimately, the trust company makes the investment in the LLC that has as its member the trust company for benefit of your IRA, and then you are the manager of that LLC. As soon as that investment's been made, you go out with the power of the pen to go buy whatever investment you want to make. Earlier I talked about community-based investing or safety, comfort, having money where you want it. So as we're creating that, first off, if you want a basic self-directed IRA, we're not a trust company. Okay, we use several different trust companies. Call us up. If you're looking at something, a basic account, we'll tell you why we're working with this trust company, that trust company. In general, it has to do with what they're going to require with checkbook IRAs. It has to do with what they're going to allow with those things. It's going to also impact us with respect to costs and what is, how we're working with those things, what their requirements are, how they're charging you, and the amount they're charging you. And I'm sort of, just for the sake of today's conversation, I'm really, obviously with Wall Street investments, it's fine for somebody to charge based upon the value of the account because you've got stated values every day, every minute on Wall Street. When we're looking at a self-directed account, a lot of these assets, you've got to go out and get valuations for. What is a piece of property worth? It's worth what two people agree it's worth. So with a self-directed account, I'm really fundamentally opposed to a trust company charging my clients based upon the value of their investments because there's too many variables there. I would much prefer to have my people paying a trust company based upon the number of investments. Keep in mind, with a checkbook IRA, there's only one investment. So when we're looking at those IRAs, we're going to move what you want to use from trust company A to trust company B, or retirement account A to trust company B. And as that's happening, we will have created the LLC. If it's a checkbook IRA, we get that limited liability company. We'll do the articles, the operating agreement, which is IRA specific, the federal tax ID for that. We're going to get that to you. You're going to go to the bank of your choice, open a checking account in that LLC's name and federal tax ID number. You as manager are going to be signer on the account. As soon as you get that account open, you're going to get us the account information. We're going to direct the trust company to make the investment in that limited liability company, funding that bank account, and now you're set to go. Now you just, with a pen stroke, go do what you want to do. Works great. At the end of every year, the trust company is going to want to know what the value of all cash and assets that LLC has, because they really have no way of knowing. But it works great. It's been there. It's been something that's possible for a long, long time. If, once again, let's say you're a real estate broker, self-employed, no employees, I'm going to do a solo 401k instead of the IRA for a variety of reasons. But one is there's no tax on leverage with the 401k plan where there is with an IRA. People ask, well, gee, why is it that way? I said, well, some senator had the 401k. Right, I sort of, once again, tongue in cheek, I'm joking about that, but there's no rational reason for these things. So once again, with an IRA, if you got a property, you go out and buy it, and it's 50% loan to value, half the income and half the gain is going to have tax exposure with an IRA, even with a Roth IRA. A 401k plan, it's not going to. Once again, the other, another benefit of the 401k is that prohibited transactions, only the money involved with indiscretion versus the whole thing. You don't have a trust company, so you're just going to have, with a solo 401k, you're going to have a bank account, once again, at the bank of your choice, in the plan's name and federal tax ID number. You're the trustee of it. You've got the power of the pen, once again, just like a checkbook IRA, to go do what you want all the time. So unlike an IRA, you can borrow against a 401k plan too, right? You can borrow half what's in the plan up to a max of $50,000. So, we've got lots of people that want to do something, maybe they're doing a business startup. Instead of us going through and creating that full rollover business startup, we'll just use a solo 401k, and then they'll take, maybe they borrow the 50 and use the 50 to do the startup. They don't have to go through all the C Corp and everything else the rollover business startup entails. So there's a variety of reasons, but these things, solo 401ks are great. And once again, none of this stuff is new. It's all been possible since retirement accounts were started in the mid-70s. So, back to IRAs, yes, they're possible. They're out there. Got to be non-recourse debt. I'm not going to cover much here. We've been sort of beating on it throughout this class. So once again, non-recourse. Whether you get it or not, you're not going to walk into one of the big banks and get a non-recourse IRA compliant loan. They're just not going to do it. And credit unions aren't going to do it either. They might tell you they're going to, they're not going to. So in this situation, you're going to a regional bank portfolio lender or somebody that's specifically deals with these things. And as I say, you can type in myiralender.com or iralending.com. A North American Savings Bank's a bank that's specializes in this and has done it for years, and they've got a nice little book on it too, on leverage investments and how to treat them for tax purposes, so on and so forth. But they're out there. It's just not going to be through your friendly mortgage broker typically. I'm not to say your mortgage broker can't get you one of these, but they need to understand what is required, and it's got to be totally non-recourse. but they're out there and it happens. Most of our clients buy things outright, but if you do want a loan, you can get it through one of those channels. So you're writing an offer, and I talked about this page a little bit earlier. You're writing an offer to go buy a piece of property. It varies a little bit depending on whether you're using a basic self-directed IRA, a checkbook IRA, a SOLA 401k. But as number one says, if it's a basic account, we want to make sure that the custodian, that you have time, that you've got a contingency in the purchase sale agreement stating that this offer is subject to the custodian's approval of said investment. Because I'd hate to have you tie it up, put earnest money down, the custodian says, not going to make that investment. So make sure you got that in there. If financing's in there, make sure you got something stating that it's subject to IRA specific, IRA 401k specific non-recourse debt. And then depending on whether the account's established or not. So what do you do if you find a property that you got to write the offer on and you're not set? So this thing, like I said, this says 2 to 4 weeks. I think two weeks. If we're talking about SOLA 401k, we can get it done, but it's not going to happen with an IRA these days. So you want to make sure, once again, you're ready to go do these things before you go shopping. Inevitably, you're going to find something before you're ready. But let's say you find that perfect property and nothing's set yet. Well, have your brother, sister, cousin write the offer, and they can put the earnest money down. Then they can assign the purchase sale agreement to your SOLA 401k or to your checkbook IRA in the future. But that would allow you to get the thing tied up. Don't use mom and dad. Don't use one of your kids. Those things would all, or a company that you're a controlling owner of, because all those entities, people or entities, are disqualified parties. Using them to write those offers because you're not ready wouldn't accomplish anything. So we want to make sure you're set to go before you go shopping. Selling the property, really no different than anything else. The nice thing is that, and I want to caution you. So early on, some of the people that were in this space that were working with self-directed IRAs years ago were sort of saying, gee, why would you use a 1031? Why not just use IRAs to buy things? Well, I jokingly say this, I sell retirement accounts. I'm not a huge fan of them sometimes because, whatever's in's got to come out. I'm a real estate guy. So if I've got the choice of pulling money out of my pocket to go buy something or using my plan to buy, I'm going to, pull money out of my pocket to do it for a variety of reasons. But, that's not what we're talking about. What we're talking about today is why not have that account that allows you to diversify. So when we're selling these things, understand when you sell it, depending on the type of account we have. If it's a basic account, you're going to negotiate a sale as you normally would. If you're the broker involved, if it's a basic account, you're going to have a listing agreement between, honestly, you and the trust company. If it's checkbook IRA, you're going to have a listing agreement between, the broker and the IRA LLC. If it's a SOLA 401k, you're going to have a listing agreement between the broker and that SOLA 401k account. And as that property sells, the funds are just going to go back into the account. And they're ready to go do what you want to do in the future. Now, the people that used to sell, the IRA versus 1031 situation, it's sort of like 1031 and opportunity zones. They're apples and oranges, two totally different things. An OZ is not really a fallback for 1031 unless you got to plan ahead once again, because an OZ's only got 180 days to spend the money. So if you, in a 1031, you think, well, gee, I'm going to use the OZ as a fallback, you've ID'd things, you're outside the 45 days, you're stuck now, all right? You can't get the money per 1031 G6 until day 181. So it could be a fallback. You just got to be prepared for it. Once again, don't plan, fail to plan, or plan to fail. So in this situation, when you're selling a property, you're just going to sell as you normally would. The money's going to go sit in the account. It's just going to sit there and wait for you to go buy that next thing. What's the biggest problem with a 1031? Time. You don't have these timelines with a retirement account. You've got an IRA-owned asset, 401k-owned asset. You sell the property. If it's not something that you've conducted business or was considered a business transaction, flipping property, for example, is not an investment. Okay, I'm going to say that again. Flipping property does not qualify for 1031, and it will trigger tax on a retirement account. If all you're doing is buying, having it fixed up, and turning it, you do that consecutively, that's conducting business. It's not investment. So once again, back to that Clarkowski case, 9 points used to determine dealer status. If you're curious about that, email us, we'll get you that page. But we want to make sure that if you just made an investment, you sell the investment, the fund's just going to go back in the account. You're not going to have any exposure. All right. Business startups. So you come to me and say, hey, David, I want to go out and buy a print shop and work for it. That's fine. We can do that using a 401k plan and C corp. You say, well, gee, David, I don't like C corp, so I want to use an LLC. Can't do that. It's got to be a C corp. Well, David, I don't have 401k. I don't want to use a 401k. I want to use an IRA. Can't do that. It's got to be a 401k plan. It's got to be a C corp. But really, what happens is we're going to move the money from wherever it is today into the new 401k plan. As it's happening, we're creating a C corporation, and then we want our client, our taxpayer, you, to put in 5% of the initial capital too. But you're going to be a shareholder of that C corp along with a retirement account. I want to stress, you don't have to spend all the money in that retirement account for that thing. So you need 50 and you got $500,000 in it, use the 50 you need. If it's only 50, I'm going to say let's borrow it instead of using that C corp structure and everything. But let's say it's 100, and then that's going to allow the 100 from the plan is going to make the investment in the corp. You're going to make the investment in the corp, and now you're working for a company owned by the retirement account, which is a pretty neat deal. And typically in recessionary times, or times like COVID where we have people losing jobs, moving jobs, changing things, this is the opportunity that people use to make a new business startup using their retirement account. All right, a few examples and we're done. All right, so this gentleman just came to us, and really he wanted to go out and make an investment, just diversifying his portfolio. Actually, in this situation, it wasn't a friendly deal. This guy, spouses came to us, property adjacent to their house came on the market. They didn't want that thing just being purchased by anybody. They thought, hey, this is a good investment. We've got the adjacent lot. I want to stress, you can't use that lot that your retirement account owns as your backyard. That would be a prohibited transaction. But to make the investment in it, don't park cars on it, make the investment, have it sit there being held, that's totally fine. So they ended up using his and her retirement accounts to fund this investment. They actually added some personal money too. So we had a multi-member limited liability company. So if you think back on that bubble chart with the checkbook IRA, typically we're just having an IRA account as the member of the LLC. Well, that doesn't have to be that way. It could be his and her IRAs. It could be your personal money and plan money. If we have that IRA LLC and it's a multi-member entity and those members are disqualified parties to one another, by the way, a Roth and a traditional IRA, even if they're both yours, those two things are disqualified parties to one another. So can we combine them into a common LLC? Yes, we can. But if you're going to do that, you need to overfund that LLC. You can't add money in the future. You've got to put into it what you want. And my advice is, if you think, hey, gee, I need 200,000 to go do this thing, put 230 or something into it. Put 250 in it so you've got a cushion. Because anybody that owns these things will tell you once in a while something comes up you didn't expect, and you got to have a cushion there to take care of things. Obviously, the cash flow is going to create that cushion in the future, but starting off, just plan to have enough in there and cover any potential shortfall you might experience, just in case. Be safe, all right? But in this transaction, we had his IRA, her IRA, and we had personal money in there too that made this thing happen, which is fine. We just can't have more money coming into the LLC after the initial funding. Now, investment yield's fine, but we could not have funds come from a disqualified party into that limited liability company at a later date, overfund that entity, so you're fine. So this guy, dipped his toe in the water. Hey, I don't know. I've never had a self-directed IRA. I heard about it. Like the idea. I've got a buddy on the coast that's got development. He's having a hard time selling some property. We're going in this recessionary time. This is not now. This is back in 07, 08. And he says, hey, I've got the ability to help my buddy and diversify my portfolio. So he went and self-directed a chunk of money to go out and buy that property. And then after he did that, he ended up moving more money into the self-directed IRA, which was possible since it was a single member entity. And then he further diversified his portfolio through the years, ended up buying into a tenancy in common project, multifamily project, ultimately buying a condo. But he did a variety of things over time, but he started small with this one investment, which gave him the diversification, gave him the ability to help a friend as well. So, made a difference locally. This is a guy, once again, the last crash, dirt was dirt cheap. So the issue is, when am I going to be able to build on it? And, who knows? So he wanted to land bank using the retirement account. So we created Checkbook IRA, and that allowed him to buy the land to sit on it until it was to be developed in the future. Now, the problem was that he wanted to be able to work and do the development in the development work in the future. So if he were to buy the land from his retirement account, that would be a prohibited transaction. If he were to work on the property with his construction company, that would be a prohibited transaction. So we created a second limited liability company that put him in as 1/6 owner. As his ownership at 1/6, that entity is not a disqualified party to his land bank entity. So we could he could do the land banking with the retirement account as they want to develop it. He'd move it, sell it to the other entity that was 1/6 member of, but 1/6, once again, it's not a prohibited transaction between disqualified parties, and then they would build it out and get rid of it. So, once again, if you look at it, it gave him, it reduced his carrying costs, gave him the access to the inventory he wanted, and it built a structure that benefited his retirement account and gave him the ability to go build on these properties in the future when he needed to or wanted to. This example is one where the guy came to us, once again dipping his toe in the water. He says, "Hey, I want to know, can I go out and buy this mobile home RV park?" Which anybody on this call that's got those things, obviously they're a very popular investment today. This guy had lots of doors. He was sort of a terrible tease refugee, terrible tease toilets, trash, tenants turnover. And so, initially he approached us because he wanted to buy a mobile home RV park. He ended up shifting gears, called up, "Hey, can I buy notes, make loans with the retirement account?" Which, of course, the answer was yes. And once again, this was during the last crash. So he ended up buying or financing. He didn't buy. He had somebody that wanted to buy a property down in Palm Desert that had been a quarter, it's 200, I think it was 250 actually, $250,000 pre-crash. The thing was trading at $70,000. The cost of capital was going to be 11%. So he says, "Hey, I want to buy that loan." It was 50% loan to value, paying 11%. He loved that. And that worked so well. He had the same mortgage broker had a variety of other opportunities for him. And the last one that he did was I think it was a $950,000 note, paying him like 18%. It was a wind power company that was wanting that money. And, in that situation, I guess my rules on notes, paper is never anything but a first and never for anything more than you'd be happy owning the asset for. So just keep that in mind. Seconds have a tendency to be worth what the paper they're written on is worth. So, I just be careful on that stuff and make sure, once again, never anything but a first and never for any more than you'd be happy owning that asset for if you had to actually foreclose on it. So, this worked great for him. He didn't have to deal with that, the toilets, trash, tenants turnover. This is a situation where a guy was having a problem, and if you think back that the last crash, not only were loans being called and people losing property, short sale and foreclosure, which I want to sort of stress, if you're talking about property owned by you directly, let's say not in a retirement account, understand that in recessionary times, a few different things happen. Typically, just selling something, buying something, 1031 requires you go across or up in value and equity. And a lot of people are confused because they're told they have to replace debt in exchange, which is untrue. Debt can go away by going down in value, triggers tax because you went down in value. The other way debt goes away is by adding cash. So you've typically got a reduced LTV in those times, and your equity's going away at the same point. So you can always add cash to a transaction. So I have people that come say, "Well, gee, do I have to pay the property off predisposition because I can't or don't want any debt on the replacement?" And that's unnecessary. You can always add cash at that point in time. Well, the caution I want to give you is that debt on an investment property, if you lost a primary residence foreclosure short sale, there's tax relief there. On income properties, there's not. So in a foreclosure or short sale, if the debt exceeds the basis, the debt is treated as a sales price. You could lose a property and have tax exposure. It's called phantom gain. So just be aware of that. In this particular transaction situation, the loan was going to go away because the bank was going to go away. I mean, this is a WAMU loan. Anybody remember WAMU out there? WAMU is going away. If the bank goes away, the loan goes away. The guy was going to lose it. He's a developer. He had, $1.8 million in equity in a $3 million property. He really did not want to lose that. His father had, an IRA with a couple $1 million in it. And he asked, well, could we take Dad's IRA to pay the property off? And he just did that directly. Dad's a disqualified party to him, or he's a disqualified party. Junior's a disqualified party to senior, so that would constitute a prohibited transaction. What we did is create a new limited liability company. Junior contributed the property to the limited liability company. Dad's retirement account made an investment in the LLC at the same time, and now you have a property that's owned by the limited liability company and has the cash to pay it off. And they ended up holding the thing that way for years, ultimately developing the property. But once again, this is an example of something that is possible. You just need to talk to the right people, get your tax and legal people to understand, be comfortable with these things. Last example, all right, so this is the one I gave at the top on the rollover business startup. Spouses came to us, retired. They said, hey, we want to use his and her IRAs to go out and buy this mobile home RV park. And said, okay, great, we'll just do a multi-member checkbook IRA LLC. And that would have taken care of the thing. Well, then they mentioned they wanted to be the on-site managers and, they wanted to live there. So both of those things would constitute prohibited transactions. So we shifted gears away from a checkbook IRA and into a rollover business startup. So we moved his and her IRAs into the 401k plan, created the C Corp, the plan bought the Corp bought the park, and now they got an investment, they got a job and a place to live, all with that one structure. And I just really think that's a cool story. Gives you a real extreme example of what is possible, and it really gave them the olive branch of the future they were looking for. So IRA investors checklist. Plan ahead, takes 2 to 4 weeks to get your self-directed account established. You can purchase all types of property with it, IRA, SEP IRA, Roth IRA. You can purchase with family members, friends, cannot purchase from or for them, all right? Your IRA cannot sell to you or any other disqualified party. You can use an IRA to buy property with a mortgage, negotiate from the deal's inception, the IRA or IRA LLC's name or solo 401k. Don't overextend. Plan on keeping a nice cushion for reserves. If we're talking a checkbook IRA, just an example of that is most trust companies are going to minimum investment or a minimum balance in the custodial account. So with an IRA, once again, the money's going to move from wherever it is. It's going to move into that new self-directed custodial account, and then from there, the investment's made in the LLC. Well, the trust company's going to want the one we typically use wants to see a $500 minimum float there, just so fees can be paid. Now, a common problem, okay, a common prohibited transaction would be to take and make just a contribution straight into the LLC, not running it through that trust company, or taking funds as a distribution straight from the LLC out and not once again through that trust company. Anything with the IRA has to flow through that trust company, either in or out. Now, if we're using IRAs, and I said it's not all or nothing with IRAs, I'm just saying this, I want to stress at the end of this presentation that, in addition to segregating the Wall Street stuff from your self-directed account, what's very common is as a self-directed account, if you go buy a piece of property, the monthly cash flow is going to end up piling up there, and you might have a period of time where you say, gee, I've got a lot of money in here, but it's not critical mass to go out and buy another property. So I want to just take that money and make Wall Street investments with that. Well, the easiest way to do that is simply open a Wall Street account in the LLC's name and federal tax ID number. And then you just move money straight and forth between your LLC and that investment account. So once again, the investment account with your Wall Street advisor is going to be in the LLC's name and EIN. It's not going to be under your name and Social Security number. Okay, we don't want that to happen. That would be, a prohibited transaction. If you, so the easiest way is just to have a new account in the LLC's name and EIN, but everything in that account is encumbered by your other activity, where the safer way, once again, as the money's piling up, is just move it from the IRA LLC back through the trust company, back to your Wall Street trust company, and take care of it that way. That way, it's totally segregated those two accounts, and you don't have the ability to encumber each of those accounts together. So it seems like in life, it's never, the easy way is never the right way. And that's just another example of that being the case. So anyway, cannot sell to you or any other disqualified party. You can use an IRA to buy property with a mortgage, negotiate for the deal's inception, the IRA or IRA LLC's name. Don't overextend. Like I said, keep a cushion there for reserves. Real estate is real investment. And that just, once again, harkens back to my comments on it being an alternative investment. Thank you so much for joining us today. IRA Advantage, you can find us at iraadvantage.net or iraadvantage.com. If you're interested in 1031 information, take a look at 1031exchange.com. If you're, if you got property, you want to try to get out there in front of our 1031 clients, go to post1031.com. I would also invite you to take a look at our YouTube channels. We have YouTube channels for IRA Advantage and Equity Advantage. There's over 100 videos up there on all different aspects of these things. And it's quite possible that if you've got a question, the answer is going to be contained in one of those videos. If you've got questions that are not being addressed up there and you'd like to see us do a video on something that you're not finding, please let us know, and we're happy to create content. We're always looking for great content to get out there. And you might take a look at those, our YouTube channels, and find stuff even on charitable remainder trusts, or even investing in life contracts, or selling your life insurance contract. All those things are up there, and I hope you find that information helps you in your investments, and helps you, and if you're a broker, with your investors as well. Once again, David Moore, IRA Advantage, thank you for spending the last little bit of over an hour with me today. If you need credit hours for this, reach out to Seymour at 1031exchange.com, Seymour, C-M-O-O-R-E at 1031exchange.com. And all my best to all of you out there. Take care, and look forward to hearing from you soon. Bye-bye.